Dear friends, welcome to another video in the series Learn Finance and Accounts. In this video, we'll be talking about time value of money. According to the concept of time value of money, money available at the present time is worth more than the identical sum of money in the future. The time value of money draws from the idea that rational investors prefer to receive money today rather than the same amount of money in future. Now, who are rational investors? Rational investors are the wise, prudent investors. So, if we put in money wisely, prudently, we would use the concept of time value of money. Why? Because money's potential to grow in value over the given period of time. Reasons why the time value of money changes. See, value of money changes with time because of many reasons. Some of these are given below. The first is default risk. What is default risk? This means that the person who has taken a loan or the person who has to return money has become dishonest. He does not want to pay. So, this is called default risk. Second is uncertainty. Now, in this case, the person is not dishonest. Although he wants to pay, but there is a financial crunch, there's a crisis. He could have lost a job, or there can be some medical emergency in his household, because of which he is not able to return the money. Although the person is honest, he wants to return, but because of the conditions, he has no other option but not to return money. He is not able to return the money. So this is the second reason of why value of money changes, and why we prefer to get money in present times, not in the future. We cannot wait for the future. Third reason is inflation. Now we all know what is inflation. Inflation is rise in prices of the goods. Now when there is a rise in price, when the price of the goods increase, the purchasing power decreases. How? Suppose with rupees 100, I am able to purchase 10 units of some commodity today. With same rupees 100, after 1 year, if I go to purchase the commodity, I will not be able to purchase 10 units. I will get only 8 or 9 units. Why? Because of inflation. Now, because of inflation, purchasing power reduces. So, this is the third reason why the value of money changes, and we prefer to get money in present times and cannot wait for future. Fourth is prefer consumption today. Now, to understand this, let me give an example. If a person is hungry today, he will not be ready to wait for 1 week to get food, or he will not be ready to wait even for 1 day to get food. If he is hungry today, he will want food today. Or another example, if you have a flower pot and the flower pot needs one glass of water every day, right? And if you think, okay, no, I will not put one glass of water every day, I will put 7 glasses of water after 1 week, then the plant will not be able to survive. So this is the reason why value of money changes. So these are the examples. So we prefer consumption today. So this is the fourth reason. Fifth reason is investment opportunities. So you can say, if you have money today, if a person has to give you money 1 lakh rupees, and the person gives 1 lakh today, you can invest that 1 lakh in a bank. You can put that 1 lakh in a fixed deposit in a bank and earn interest. So we can have investment opportunities where we can earn interest. So we would not want to wait for 1 year, because in that way we'll be losing the interest portion. So these are the five reasons why value of money changes, and we prefer to get money today rather than wait for future date. Now we have talked about two values. One is present value and one is future value. What are they? They are the values of the same amount. So 100 rupees, the value of 100 rupees today will not be the same value in at a future date. So present value is more and future value is less. in most of the cases. So present value is how much the future money of is worth today. What is the value of the money today? Present value provides us with an estimated amount to be spent today to have an investment worth a certain amount of money at a specific point in future. So present value is also called discounted value. It is an indicator for the investor that whatever money they receive today can earn a return in future. It is one of the most important concepts in finance and is the basics of everything which is concerning finance. For example, like a small thing like making a fixed deposit in a bank, or pricing of a bond, or insurance, or financial modeling. So anything which is concerned with finance is they they most value will have the concept of time value of money. How is present value calculated? Now let us see how present value can be calculated. The formula for present value is CF divided by 1 plus R raised to power n. Here CF is the future cash flow, what we are going to receive in future. R is the discounted rate of return, and n is the number of periods or years. So if we know what are the future cash flows, if we know the rate of interest and the time period, then we can calculate present value. Now let us come to future value. Now future value is the amount of money that will grow over a period of time. So what will 100 rupees that we have today will become in after 1 year. After 1 year, the value of that 100 rupees is called future value. So investors use this method to know what will be the future value of their investment after a certain period of time, which is calculated on the basis of the growth rate. So future value basically tells us how much money you will get in future in any sort of investment. Now we come to the formula of calculating future value. So future value is present value into 1 plus r raised to power n, where r is the rate of interest and n is the time period or the number of years. Example, let us take an example. Suppose Sunil has invested a sum of rupees 3000 in some fixed deposit for 1 year, and for the same he will receive rate of interest at the rate of 7%. So at the end of the year, Sunil will receive 3210 rupees, that is 3000 principal plus 210 as interest. So 3210 is what he is going to receive after the completion of the time period. So we can say that 3210 is the future value of today's money, that is of 3000. So when we go from present value to future value, the process is called compounding. And when we come back from future value to present value, the process is called discounting. So compounding is a method to know the future value of the present money. For example, let us take another example. Rupees 10,000 invested today in a bank fixed deposit at the rate of 9% for 5 years can fetch 15,386. Here 5,386 is the accumulation of interest and also interest on interest. Now we come to discounting. What is discounting? It is a method to compute the present value of future value of money. For example, you want rupees 15,386 in 5 years from now, and you know the prevailing rates of the bank. So how much money should be invested to get 15,386 at the bank is giving a rate of interest which is 9%. Time period 5 years. So you can calculate that if you want 15,386, then you will have to invest 10,000 today. So that is all for today for this video. If you liked this video, please like and subscribe to the channel. We'll meet again in a next video. Thank you.